Hello, my name is Tim, and my channel is The Stock Market is My Game. Um, so I thought what we would hit today would be, I've hit what a covered call was, what a naked put was, some things, but what I really haven't touched much was how our option price is determined. Okay, so in the most simplistic way, if you think of I'm an electrical engineer, so I like to think of inputs and outputs. Okay, so all the different inputs you have is um, you have what they call the implied volatility, the stock price, um, what the current strike price is, the time of the contract, and what they call the interest rate. Okay, so the ones we like to hit, we the ones that we like to look at the most is implied volatility, because we have what we call, we want sometimes we want to see the implied volatility go up, sometimes we want to go down, and I'll explain what that is in maybe a later session. But basically, what implied volatility means is what the market thinks the involved, how much risk there is in the stock. Is it going to go up a lot or down a lot? Okay. Then we have the stock price, the current price, stock price, and then we have the strike price. So the strike price and the stock price and the strike price, they have a relationship, depending on the type of option it is, a put or a call. Um, it's going to be above or below or at what we call the money. So, and then the big thing is the time of the contract, and that's something that you pick. You pick how long you want to go out. Do you want to go to a short-term contract, like a week, a month, 45 days? Even you go out a year or 2 years. So all that depends on what your investing strategy is. So you put all this stuff into a formula, or I call it a box, and out comes the price of the options. Now, what is that formula? So um, there's a thing called the Blackshells model, and that's basically what the stock prices use. So the Blackshells model, and I've got some stuff here. I have some history here. The initial equation was introduced to Black-Scholes in 1973 in a paper called "The Pricing of Options and Corporate Liabilities," published in the Journal of Political Economy. Black passed away 2 years later before Scholes. In 1997, the Nobel Prize in Economics for their work finding a new method to determine the value of the derivatives. No prize was given to these three guys for this equation. And here's some more other stuff we talk about. The option is European. It can be no dividends are paid out. These are assumptions that you can see that they look at for the for the equation. Okay, so what I want to look at right now is I've got one here that shows what the inputs are. So here are the inputs that I found. From the formula, you'll notice the 6 inputs are required are the underlying price, the exercise price, the time to the expiration, the risk-free interest or the rate of return, the dividend yield, and volatility. And that's everything I had put in this this slide right here. Okay. Now, so what is this equation? Well, this equation is a differential equations. And here's some more about the initial equation. And it talks about is regards best ways to determine the equation. And here we go. Here's the equation. Holy moly, what an equation that is. Look, this is the calculation. C equals ST ND1, which is this guy here, minus K, which is this guy here, times e to the e to the minus RT times the n, which is a probability, a normal distribution of D2. What the heck is this? And here's the equation for D1, which is this guy, and this is D2, okay? And I've tried to look at these before, and try to figure this out like this. So basically, it's exactly what I said. C is the call price option. S is the current stock, which is this guy right here. K is the strike price. R is the risk-free rate. T is time to maturity, and N is the normal distribution. So what's that mean? Well, it means it's a nasty formula to figure out. Okay, so and there's some more work about we talk about the equations. Okay, regardless, one of the best ways to determine the price. We can go on and on and on. Now, one important thing I do want to say here is they said that the equation it uses the log normal right here. This is the log normal, okay? The normal distribution, okay? What that means is that the price can't go below. They're assuming that this price of the stock can't go below 0, okay? And there's an example of the equation right there, a normal distribution, and then it says a log normal means it can't go below 0, okay? So that's all nice. But to us as traders, what does that really mean? So if you pull up a normal, what they call options table, you'll see that there's options chain, they call it. You'll see there's the time of the contract. So you can see right here, this is the time. This is when the contract is due. This tells you how many days are left until the contract is due. This tells you basically that this represents 100 shares. And the implied volatility is 13.53, okay? And what they do is they tell you what that's equal to. That's equal to plus or minus $9 or 9 points, okay? And then you can see down here, there's all kinds of different times. And here's one where I opened it up for you, okay? This is in Thinkorswim. So you can see I opened up this one here for it was SPY on July 6th, okay? And you see this is referred to as at the money right here. This is the current price. If you see this changing color here, this signifies that you're right at where the stock is trading right now, okay? So you can have, this shows you the price, the bid and the ask price. And this side here is the puts, and this side here is the calls. It shows you what the price is per contract. And as you see, as you go down, as you go up or down the options chain, the price is going to change. Okay. So what I thought I would do is, while I'm here, I'll go ahead and I'll open my Thinkorswim. There's my Thinkorswim. It's basically the same stock as the SPY here, which is the S&P 500. Okay, so let me go up here to charts, show you how I got there. Just take a second. So right now, this is Sunday. The market's not open right now. Actually, it's 9:16, so it's not really open yet. Okay, so the way you get here in Thinkorswim is you go to trade and you go all products, and there you go, and you can pick the symbol that you want. Okay, I just picked the SPY. Okay, so let's say you see my volatility is 11, 13, 13, 13. So there's not a lot of volatility expected. Now, if you go to something like one I use a lot is Workhorse. That's one of my go-to if you open that, look at that, you see a volatility of 121%, which is representative of 121% in volatility. Implied volatility is what that stands for, and which means a 1.97 chance expected move of one standard deviation that it can go up in workhorse. But the problem when you see that let's say here 1.27, but look at the price right now, it's $10. So it means it go up to up plus or minus 1.2. So let's go back to my go-to SPY. And there you go. So we're going to pick, let's say this contract here. The SPYs have more contracts there. I think there's Monday, Wednesday, and Friday, okay? So you see right here, this is at the money right here. So this would be at the money. This would be in the money. And this would be out of the money. These are terms. You don't have to worry about it right now, but basically this is something when you say, hey, my option's in the money, out of the money, or at the money. So at the money, in the money, and out of the money, okay? So this is considered a put, and this is considered a call, okay? And look here, you can see what the price is right here of 2.49, right around $2, okay, for the price at the money, okay, which represents a 12%, okay? Now, I told you that there's, if you go up here, I'm going to go up here, and I'm going to pick this thing called, oh, where is it? Where are you? I don't see it. Oh, theoretical price. There it is right there. See where it says theoretical price? What happens is when you pop that up, you'll get this column right here. And what'll happen is when you get that, you'll get this. So you can say, okay, hey, what is the theoretical value, let's say Monday, okay? And you're assuming that the stock price stayed the same and implied volatility stayed the same, okay? Boom. Oops, let me close this here. This will tell you what the implied what the theoretical price is, okay? If it stayed the same, your theoretical price will be there. Here, okay? And you see the price here, and you see something's wrong here. Let's go to day. Today's the 25th. All right, close this again. There you go. So today's the 25th. Let's go to, oh, I see what I did. Let's go 27th. See what happened here? The price here today is this price, okay? In 3 days, the price will be here, and that's what we're looking for. So this is one way that you can go in and you can, hey, if I say, hey, what if the price of the stock went up, let's say $1, and I can put that in here and get an answer. And you can see that right there, okay? So anyway, that's just showing you what they give you a beginner's of the options chain, how to get there from on toss, what the theoretical price is, so we can go back to our one of our beginning thing here. So what I'm saying is there the price of the the option is a differential equation and depends on all of these guys here. So it's hard to, some of these things will be more of a constant, like this will be a constant. This is going to be a constant once you set the time. The strike price will stay constant. The stock price will be variable. It'll go up and down as time goes along, and your implied volatility will go up and down depending on what the um, the market does. If it's getting closer to earnings, then your implied volatility go up. If it's after earnings, it'll go down. If the market is having if there's a tweet or some news in the company, your implied volatility can go up quickly, and so can the stock. So I hope that kind of helped you a little bit on this. I hope you continue to watch. Give me a like if you like what I'm giving. Before I leave, let me make sure I am not a financial advisor. I'm just trying to give you some of my thoughts into the stock market. It's taken me a long time to get to this point. Um, Believe it or not, there's a lot of research here. So again, if you like it, please give me a thumbs up or subscribe. I appreciate it. Thanks a lot.